Hi guys, welcome back to our channel. If you are watching, please subscribe. Today we will discuss about measurement after recognition cost. It's like what are the measurement after recognition. So measurement at recognition, we have completed this. What are the elements of the cost? How we measure under the deferred credit system and also monetary and non-monetary combinations. So now we are at measurement and recognition stage. So in this also we have cost model and revaluation model. What is the cost model? What is the revaluation model? And then what are the additional points if you select the revaluation model? We will cover today. So in the previous class we have completed this class, like what is the measurement after recognition, the cost model and the revaluation model. See, this is the cost model and this is the revaluation model. So this I will explain with the practical example. Before I explain, I just revising the previous class. So the revaluation model will be selected when the fair value of the PPE is volatile or non-volatile. If it is in volatile, we need to revalue at annually if required. If it is non-volatile, the changes are not frequently in the valuation of that particular PPE. We will do that valuation in 3 to 4 years, that revaluation. So what are the revaluation clauses? And you should know, right? All these revaluation should be done by class wise. So each class, this class can depend on different characteristics. Say suppose these are industrial use and then corporate use. So based on the use, so based on the area, building area, so their industrial area, corporate area, warehouse, based on that you can divide the class of your asset. So land and building, in the also there will be separate classes, okay. And then in the land and building you have factory building and office building. So for factory building you can use cost model, for office building you can use revaluation model. The same similar nature, similar use and nature, and their production package based on the use. Also you can divide the class based on the nature. Say suppose leasehold, factory, electrical, vehicle, computers, like that. And based on the value, say some values are higher values in the valuation and some are moderate value and some are low values. These are, and based on the value also you can differ your classes. That's the useful life. Few assets have useful life of 20 years and few assets of useful life of 3 years. So in those case you should select 3 years useful lives are one class and 20 years useful lives are another class. So based on the class, once you selected any asset in 3 years value useful life, you have thousands of assets. So if you want to revalue 200 assets, then you have to revalue another 800 assets in the same class. So class wise, entire class we have to revalue. Okay, I hope you understand this. And now what we will do if we completed the revaluation is the question. So say suppose I will give one example first and then you will understand how we'll revalue and all. Okay, first I will explain the depreciation elimination approach. We have two approaches are allowed in the Ind AS. One approach, second approach. The first approach is depreciation elimination approach and the second approach is restatement approach. Two are allowed as per Ind AS. As per Ind AS 16, these two approaches are allowed. The first one is depreciation elimination approach and the second one is restatement approach. See, both are allowed under Ind AS 16. In that case, how should you select and what is the appropriate, what details are available in each method, we will know. In depreciation elimination approach, you just see them. First you take the cost. So you acquired one asset on the year 1 for 1 lakh and on beginning of the year, and in the ending of the year, these are the information available for you. In the ending, the depreciation of that asset is 50,000. In the revaluation year I am saying, not on the in these 2 to 3 years that happened. So depreciation, accumulated depreciation is 50,000. So how would you account in general? PPE 1 lakh and also accumulated provision for depreciation 50,000. So this is how you valued in your books in the initial stage until the year of provision for depreciation, until the year of depreciation. This is the situation you might have used. In those situations, in depreciation elimination approach, you should uh, first you see the gross value is 1 lakh and accumulated, this is the gross, and accumulated depreciation is 50,000. This is the accumulated depreciation. So in the year end, in the revaluation year end or between, the value of this asset P or PPE or asset is 65,000. Okay. In this case, in depreciation elimination approach, you should eliminate this accumulated depreciation first. So how should you eliminate? You just reverse that entry. Generally, provision was in a credit side. You just delete it. Accumulated depreciation 50,000 to where you delete to PPE 50k. If you delete this accumulated depreciation, your PPA value should reduce to 50,000 because 1 lakh is your gross amount. Now you reversed the entire PPE to the extent of accumulated depreciation available in your books till the revaluation year, that you eliminate. Then your value should be 1 lakh minus 50,000. 50,000 is your 50,000 is your new depreciation, sorry, new carrying value, or else PPE value. There is no carrying value now because it's already reversed it, right? So it is 50,000. Now your revaluation value is 65,000. So you should increase your PPE because it has been increased. Your asset has been increased. So you should increase your PPE cost. Then your PPE is 50,000. What is this? This 50, sorry, this 15,000. This 15,000 is revaluation surplus account. 15,000. So this 15,000 is the revaluation surplus account. How will you treat this revaluation surplus account? I will do in the next videos. So until now I will explain this revaluations data, revaluation from PPE side. So how will you treat this PPE and all, I will explain first. So your new value is 50,000 plus 15,000, 65,000 is the your new new PPE were cost after reversing their accumulated depreciation. So how will you show this in your books now? Now you see your value is 65,000 now, and then this is the another revaluation date. Okay, if any balance period is available in this particular revaluation year, say suppose you revalued in the month of December, so your following financial year April to March, in this particular period, if you calculate any additional depreciation, I mean any depreciation for this balance 3 months from Jan to March, say suppose that is the 2,000 depreciation value. So then your gross value is PPE value is 65,000 and your accumulated depreciation from revaluation date to another reporting date would be 2000. Again this so depreciation account data to depreciation account data 2000 to accumulated depreciation or provision for depreciation 2000. Okay, I hope you understand this. With this you can you might have understood what is the depreciation method for depreciation elimination approach if you have an revaluation. If you have cost model, you don't need to check all these process. But if you have an revaluation model, you need to check these two cases. What is the depreciation elimination approach and what is the restatement approach. Now you completed this depreciation elimination approach. First you see this is the example what we discussed, and then this is the carrying value at this stage. So at the revaluation date you need to reverse the entire depreciation to your PPE, so that your PPE would come to 50,000. Then you will increase your value because the value is 65,000 on the revaluation date. So you increase your PPE to the extent of the revaluation. You transfer that reserve to the revaluation surplus if it is an positive side. If it is a negative side, that should be a P&L account. That I will explain in the next classes. And the carrying value should be 50,000 and the revaluation surplus should be add that. So remaining depreciation for the any further depreciation you should reduce that, and then that will be the year end carrying value. This is how the depreciation elimination approach will works. But we have an another method now. If you see, this is the restatement approach. Restatement approach means you don't delete any you don't delete any depreciation amounts or all. You just track those amounts. Say suppose the example is same. 1 lakh is your gross value and accumulated depreciation is 50,000, and then your carrying value is 50,000 on the revaluation date. But the first information, the revalued amount is 65,000. In this situation, in the restatement approach, you just calculate the percentage of the increase between the carrying value and the revalued amount. So the percentage is 30% here because it increased 15,000 for 50,000 carrying value. So it is 30% is the increased value. So you just increase entire class, sir, entire groups. Say suppose on gross level also you will increase the 30%, and in the accumulated depreciation level also you will increase 30%, and the carrying level also say suppose before before depreciation it was 31 lakh, gross is 1 lakh, and after the revaluation it is increased 30%, so it will come 1 lakh 30,000. Accumulated depreciation was 50,000. After you adding this 30%, it will come additional 15,000 will increase. So the value would be accumulated depreciation now is total 65,000. And then carrying value is, this carrying value is 1 lakh plus 31 lakh 30, and then 50,000 plus 15 65,000. So if you check this, the carrying value is earlier 1 lakh minus 50,000 is their carrying value. Now it increased to 65,000 because you increased this 30% in all levels, gross level, accumulated. So again on this 65,000 you might have additional depreciation also. So suppose I'm just seeing the another standard here. See, this is the restatement approach. Just now we discussed this restatement approach. In this restatement approach, the carrying value, fair value is same as per the earlier example, but we have increased the fair value to 65%. So the carrying value difference and the fair value difference is 30% in this case. So by with this 30%, you should increase your PPE first. The gross level, the PPE will increase the 30,000. The same year gross is same, right? The cost will increase 30,000, and the accumulated depreciation also based on the percentage. You increase that to another 30%, and then your revaluation surplus, because this increase because of the revaluation only. So you just transfer that revaluation to revaluation surplus account. So this 15,000 revaluation surplus account credit side in the balance sheet, you should increase this. Then before your revaluation, this is the status. PP is 1 lakh and accumulated depreciation is 15,000, and then carrying value is 50,000. And then in the revaluation stage, this is the increase. 30,000 you have increased. 15,000 also accumulated depreciation you have increased. The balance is revaluation reserve. If you do the calculation after the revaluation, 1 lakh plus 30,000, 1 lakh 30,000 your value, and then 65,000 is your accumulated depreciation. Balance carrying value is 65,000. Then is there any further depreciation, and on the year end if you have any depreciation, you can do that. In this method, in the restatement approach method, tracking is available. Tracking means when will we revalued and what is the main cost of the asset and all. But in this depreciation deletion elimination approach, there is no tracking available. This is the only difference under Ind AS 16, and rest all are the valuation part is same. But most of the entities, the big entities will do this approach only. Say suppose in exam, if they ask this question, you just do two methods. Or if they ask specific method, this approach or this approach, you should do, as a student you should learn both approaches. If they ask specifically this approach, you should do. If they do not ask, you do this restatement approach, and also tell that this is appropriate as per the indication, as because the tracking is available. But numbers are same in both approaches, but you should check which method is appropriate for your entity. Most of the entities, this is the best approach. This is the depreciation restatement approach is the best approach for most of the entities. Other entities would be the different other entities may differ with the approach. But I mean, this would be the better for them, that this would be the better for them. But end of the day, you should see, uh, based on the information available, which method is appropriate for the entity. So I hope you understand this. I will explain one more example if you want. See, in accumulated depreciation at the revaluation date, you should check which method you are using, either depreciation elimination approach or restatement approach. I am repeating intentionally because the confusion is involved in this concept. That is why I am keep on updating the repeating the classes. So in this approach, first is depreciation elimination approach. In this, you just reverse your entire accumulated depreciation available in your books. Say suppose I will see year 1, we have an cost of 1 lakh, and then depreciation 10,000, This is accumulated depreciation. Then carrying value 90,000. Year 2, generally cost would be the same, and your depreciation is opening 10,000 plus additional depreciation 10,000. So accumulated depreciation is 20,000 now, and then net value is 80,000. The I mean WDV, WDV are carrying value. And year 3, 1 lakh 20,000 is opening plus 10,000 depreciation. Assume there is no deletions in your depreciation method and all. So 70,000 your carrying value. So in the year 4, you selected this particular PPE. What you are assuming, this is came for revaluation. So in the revaluation in the year 4, at the beginning of the year 4, you would like to revalue this amount, this 70,000 amount to 60,000. See, this is a decreasing case. So how would you value this? So out of 70,000, you have decreased your amount to 60,000. You check once. How did we account this and all? Okay. In the depreciation elimination approach, you should delete this 30,000 first to do this valuation. You should delete this. So accumulated depreciation this is credit side in the balance sheet actually, but you remove the accumulated depreciation 30,000 to which account, to PPE account, because your cost should be reduced to 30. So your cost from 1 lakh to 70,000 will come. Okay, at the revaluation time, and then this would be the zero, and the carrying value is 70,000. Now it decreased to 60,000. Okay, if that decreases to 60,000, what should you do? That is the revaluation loss to PPE 10,000, 10,000. So in this situation, your PPE value is 60,000 only instead of that 70,000. So you transfer this account to P&L account. Earlier I said you transfer this account to revaluation surplus. Now I am saying P&L account because there is a loss. I will explain in the next class what is the scenarios if you get the loss, if you get the profit, and then next year at the same method if you get the profit or if you get the loss, you should check that. I will explain in the next classes. Okay, so your new PPE is 60,000 only because this time you have reduced it. And the second case, if it is a depreciation restatement approach, in those case the values are same, 1 lakh accumulated depreciation 30 and then 70,000. Now you want to reduce this to 60,000. So generally the percentage of the reduction is this 10k is 14.2% something. So you should decrease your 14.2% here, decrease your 14.2% here, decrease your 14.2% in the net level also. So that difference should you transfer to the revaluation loss account. So I hope you understand that concept. So that 14% you should do like this. The 1 lakh is your gross and 30,000 your the 17,000 your, this is your numbers before revaluation. So out of which the 14.2%, right? So 14,200 is reduction from here, from this also. Out of 30,000 also, you should reduce 14.2%. 4,260 here, and the 70,000 that will automatically reduce, right? approximately 10,000. This is 4,200 and 10,000 reduction. So then it will come to your gross level. Gross will come to 85,800, 25,800, and then 60,000. What would be the entry? A revaluation loss 10k should decrease this elimination. Revaluation loss is 10k and the accumulated depreciation 14,000, 4,200 you eliminate, and then PPE you eliminate 14,200. So this is what you, this is the debit side. These both are the debit side because this is the loss you have to P&L, and this is a reduction in your PPE, and this is the credit side because the PPE is reducing. I hope you understand this. In the next classes, I will explain. Once you get that revaluation surplus, then what will you do? How will you account that? Say suppose here, what is the revaluation treatment for the first time and the subsequent revaluation, and what are the treatment? How will you last? This I will explain in the next classes. And then how would you utilize that surplus on the disposal? But why when it is disposal on original and closing date and all, I will do in the next classes. And post that we will start the depreciation, and then useful life for the depreciation, and then this that particular concept, and also what are the methods we should use that. All this will see in the next classes, and we will see these valuation differences between Ind AS and IFRS also. So I hope you understand my concepts, and if you still have any questions in the PP, you can comment in the comment section. I will definitely reply for your doubts, or else we will contact in the mail. I will give my mail ID in the comments. If you want, you can directly mail me if you need any questions or doubts, clarifications. And if you feel we are putting efforts, minimum efforts to get this concepts understand for the students or professionals who wants to revise these in the AS and all, you please subscribe our channel. That would be great help for us. Thank you.